Hi everyone, welcome to today's video. So a lot of you might be panicking that market fell by like 2.5%. What am I supposed to do? Am I supposed to sell all my stocks? This, that. Okay, so I thought that I'll shoot a very quick market update and then we will move on to the main video. So what is the reason for the market fall? There are two theories here. So the first key theory is that in the US, there are talks that the interest rate will be jacked up fairly quickly and it will hit somewhere around 4.5% interest rate. So as a result, the liquidity will come down and the markets will fall. So this news has already been factored in. So please do not sell your stocks in case you feel that the interest rates are going to go up. In case the announcement happens that the interest rate are not hitting 4.5% in the next Fed meeting, then the markets will recover fairly quickly. The second key reason, which according to me is a more prominent reason, is that the markets recently broke the 18,000 level, and I will put the chart here and you can see that they recently gave a breakout above 18,000 level. That was a very important psychological level, but the markets could not sustain at that level. So which means that there was profit booking that was done at this level, and whenever little bit of profit booking comes, the market can fall by 4-5%. You should not stress too much. What did I do today in the market? I bought IT stocks, and here is a video for the same. So let's move on to the main video. Hi everyone, welcome to today's video. So let me start today's video by showing you this particular chart for Nifty 50. What you will notice is that from its top, Nifty 50 right now is trading at a discount of 3.5%. So the recovery for Nifty 50 or the Indian index is almost complete. So it is almost hitting its all-time high. So let us do the same exercise for Nifty IT index, and what you will notice is something very interesting. And what you will notice is that it is trading at a discount of 25%. So this brings us to a very important question that, hey, are IT stocks right now deeply undervalued, or is more fall likely underway? Because if you just simply understand this point, this is a great money making opportunity. So I will help you understand the entire backdrop of this story, that why IT stocks are falling, what are some of the best IT stocks that you can purchase. I will do technical, business and fundamental analysis of 3 of the IT stocks. So let me answer the first critical question, that why IT stocks have fallen so much. What has been the primary reason for the fall? Now, if you go read the commentary, you will find a variety of answers here. But my answer is fairly simple, that IT stocks in India are falling because the US market is falling. Now, let me present some data to back this point up, and let me show you several pieces of data. So here is the first piece of data, and this shows a correlation between Dow Jones, which is the US index, and Sensex, which is the Indian index. And if you consider like a 3-year time frame, and if you keep on aggregating all these numbers, you will approximately get the same results. Yes, there will be times, for example, let's pick 2011, that Dow Jones gave a slightly positive result, but the Indian markets, they fell quite a lot. But the Indian markets next year, they recovered quite a lot, and Dow Jones hardly moved. So this type of narrative will keep on going in the market, but net, the story I'm trying to tell you is that, number one, from an index point of view also, there is a very strong correlation between US markets and Indian markets. There is a study that was done, and it categorically pointed out that the correlation between the Indian market and the US market is roughly 0.64%. So there is a strong correlation there. Now this theory can be also tested out at an individual stock level. So let us pick 2 giant stocks. So let's pick Amazon from the US and TCS from India, and let's see if their prices have somewhat of a correlation. So let's go to Amazon's chart here, and if we look at 1 month data, it has fallen by 10.22%. What about TCS? So again, 1 month data, 8.45%. So almost similar. What about 6 month chart? So 6 month TCS has fallen 15%. And what about Amazon? Amazon again around 13%. Almost similar figure. What about 1 year data? 26%. What about TCS 1 year result? It is 20%. So the story is very clear that the Indian giant tech stocks, they depend a lot on the US markets. How much exactly? So you can pause the video and read through this particular graphic. This is a fairly interesting graphic. Let me throw out some numbers there, and it outlines the dependency of the IT sector on the US market. So you will see that all these giant companies, TCS, Infosys, Wipro, HCL, they have enjoyed a lot of business from the US up to the tune of $50 billion. American IT service, it depends and hires a lot of people, whatnot. And if you just go through these points, you will see the extensive dependency of the Indian IT giants on the US market. Now, what is happening is that over the last 1 year, the US markets have deeply underperformed. And as a result, even the Indian IT stocks, they have deeply underperformed. So now this is a very insightful finding. And if you find this information to be useful, do press the like button. It will help these type of videos reach out to more people, and they can also make better returns with their portfolio. So the insightful piece of information is simply this, that many of us are waiting right now that, you know what, should I be investing in IT stocks, not investing in IT stocks, when will the recovery happen? You just need to answer a central question, that is the recovery in the US markets going to happen or not? If the answer to that equation seems like a yes, it might be a great time for you to go and invest in Indian IT stocks also. And probably in case you are considering investing in the US stocks, then of course it makes a lot of sense to aggregate more positions. On that note, you can check some of my best picks in the US stocks on Vested, and I'm putting those links on the description box. You can use Vested to do US stock investing. So I hope that the story so far is clear, that the Indian IT stocks depend quite extensively on the US market. That's one. Second key point, that these stocks are going to recover when the US market starts recovering. And third important point is that have the US markets started to recover? The answer there is yes, it has just started to recover, and let me prove that case to you. So recently you might have read the news that the US market tanked quite a lot, and this is the day when the US market corrected quite a bit. What was this day? This was again the day that when the US Feds made the announcement, or they were on the verge of making the announcement that, hey, we are going to jack up the interest rate. Now you tell me in the comment box that how many times you have heard this commentary that the US Feds are going to increase the interest rate at a fast rate. This has been happening for the last 6-8 months. Then the markets corrected a bit and they started recovering during the day itself, towards the day's end. And the very next day, the market somewhat started consolidating and going up. More importantly, the markets did not go down even with this announcement. What does that indicate? So this simply indicates that right now there is no new news in terms of the US markets to bring them down. It's always the interest rate issue that is being cropped up over and over again. And even this news is getting very old and it has been factored into the market as of now. And this can be back tested, that if you go back 6 months, you will see that the total fall has been only 9.5%. This is not that massive a fall as people are making it to be. So my hypothesis is that the US markets have started to recover, and as a result, even the IT stocks will be on the verge of recovery. Now let us discuss the second critical point, that are the IT stocks undervalued right now? And is the US market undervalued right now? Because you can substitute one for the other, so to say. So let me present some data here. So first key data point comes from Morningstar, where they have done an assessment whether the US stock market right now, is it overvalued or undervalued? If you see a value of more than 1, it means that that segment of the market is overvalued. If you see a data point less than 1, it means that the markets are undervalued. This is what the study is telling us. So you can see that whether you go to mid cap, small cap or large cap in the US stock markets, the market has started to become undervalued. This is not me saying or expressing my opinion. This is what the data tells us from Morningstar. So even if you go sector viewpoint, again, you will find very similar data. For example, if you go and analyze where is tech, so you will see 0.9, it means that the market in tech or the tech oriented stocks in the US, even they are undervalued. Again, you can check some of my Vests in the description box and you will get more information. But I hope you get the picture that the US market right now is undervalued. It is definitely not overvalued. Even the tech in the US seems to be undervalued as of now. So how does that data reflect back in India? So again, very quickly, let us go to this chart and you can categorically see that right now that Nifty IT index is trading at a discount of 27%. That's part 1. Part 2, if you take a look at the technical view, this is a very, very strong support. The Nifty had touched this part earlier and had bounced back. So this seems like a very, very strong support which is unlikely to be broken. So the risk reward equation of investing in IT stocks right now seems fairly positive. So this brings us to the final question that, okay, great, agreed to the argument that, hey, IT stocks are going to make a bounce back, but how do I make money? Which stock should I consider investing in? Okay, so while I cannot dissect every single IT stock that is there in India, let me analyze 3 different types of stocks. I will not give you my verdict, whether I'm investing in it, not investing in it. I will just paint the entire picture and you tell me in the comment box which of these stocks you will be investing and or avoiding. So let us kickstart that conversation and let us first talk about TCS. So let me first show you the technical viewpoint of TCS. So TCS right now is trading at a discount of roughly 20-22% from its top. So there is a healthy margin of safety. Second key point, that it is trading at a very strong support zone. So this is a very, very strong support zone. It is unlikely that unless the entire market falls down, something like TCS is going to come down below this point. So this is the second critical point. Third critical point is the support that you see here. So this is the third layer of strong support that comes, that in case the market corrects and TCS falls for whatever reason, then what is the technical target we are looking at? So we are looking at another downfall of roughly 32%. And how much this is from the top? And this from the top would be like a 50% discount on a stock like TCS. So it is highly unlikely that from a technical viewpoint, TCS will be falling from this juncture. Now, if you do a fundamental analysis, you yourself will be able to figure out and say it with confidence that something like TCS, it is highly unlikely that it will fall by 50% from this point. Yes, it can fall by another 4-5%. All that stuff can happen. That can happen with any stock. But a 50% fall, which is what the technical target tells us, that is highly unlikely. And for this, you need to go to the sales data. So you can categorically see that the sales have been rising. There has been no issues. And have the profits been rising? So yes, the profits have also been rising. There has been no issues. Third key point, that are there any expansions plans underway? This is a very interesting question because a company like TCS, it can stagnate, right? And for years, it might not generate or give any results. So therefore, it is very important to understand how these tech companies are going to grow next and are they investing their money in growth. So easy way to figure that out is that go to the balance sheet, take a look at the fixed asset and understand if they are doing any fixed capacity expansion. And for the last 3 years, you will see that TCS has been investing a lot of money in terms of expanding its fixed capacity. Maybe they are investing a big part of that money in research and development and whatnot. So this is definitely a healthy sign. And it's not as if that they have just invested the money now. They have increased their fixed capacity and they will start seeing positive results from next quarter. No, it takes time. So maybe it will take 1 or 2 years. So whatever investment TCS has made here, probably it will start generating results now. So TCS seems to have done a lot of taiyari in order to expand its growth over the next half a decade. Now, if you need to figure out that, okay, where exactly will TCS's next layer of growth will come from? In order to understand that, you need to combine business analysis with fundamental analysis. So this is a very important snippet from Mr. Gopinath, who is the CEO and MD of TCS. So in his interview, he said a lot of things. You can pause and read it. Basically, what I got out of the interview was that TCS right now, it focuses a lot in terms of cost cutting or helping its client cut cost. What TCS is going to do next is that they will help their clients in order to generate more revenues. This is a very important consideration because basically TCS, what it is saying is that we used to take a lot of outsourced work from the US, help our clients save costs, save money, all that stuff. But now they are getting into premium consulting services. Now, anyone can make tall claims that, hey, we are running this type of company, that type of company, come and invest with us. No, you need to do your own analysis. And this chart here is very interesting. It shows the client breakup of TCS, and what you will notice is that it has approximately 44% of client which generate more than $1 million in revenue. Now, why is this data point important? This data point is important because the front-end consulting services, who will procure those services? If you have got rich clients in your kitty, it is like saying this. And let me give you a parallel example. So for example, Zerodha as a business has a lot of trading accounts and they can understand which of their clients are HNIs, non-HNIs, etc. They probably have that entire database. I'm just using this as an example as an educational purpose. So they have access to a lot of HNIs. Tomorrow, if they decide to start an EMC business or a hedge fund, will they be able to figure out clients? The answer is yes, they will be able to do it. Same is the story here that TCS already has access to a lot of rich clients. And this is one of the winning modes for TCS compared to any other IT company in India, that they have access to a lot of rich clients. And if they want to move from back-end consulting to front-end consulting, they can do it, or they will have better chances of executing that plan. So now let us talk about second IT stock, which is Infosys, and it has the highest weight in Nifty IT index. So if Nifty IT has to go up, then Infosys also needs to go up. So Infosys seems like a safer play from that particular perspective. But let me break apart and talk about a few more interesting points about Infosys. So first key point is that Infosys and TCS business model right now is not very different. So this is point one. Of course, there are minor differences, that which geography they are serving, etc. But to cut the long story short, both companies try to approach almost similar type of clients. Second key point, one primary difference between Infosys and TCS is that for Infosys, almost 62% of the business that they get is exclusively from North America. This number is slightly lower for TCS. This is the second key point that you need to remember. And third, and the most critical point, is about the run-up. This is a very important point that people are missing right now. So I will just quickly walk you through it. If you go back to TCS's chart and if you take a look at the run-up that had happened for TCS from the bottom at 2020, the total run-up was approximately 146%. But what about Infosys? So if you do the same exercise, what you will notice is that its run-up was approximately 256%. So which one is a better buy or a more value buy? You can let me know in the comment box, but this is one critical difference. Now you might have a natural question that, okay, Akshat, that maybe see Infosys is running some type of plans that can help it generate massive amount of growth. Okay, so let us take a look at what type of investments are they making. Do they have any specific plan in action as of now? So here is the balance sheet for Infosys, and you will see that the fixed asset that they have invested in, they also started expanding their business quite aggressively post 2020 and commanded slightly richer valuation compared to TCS. So according to me, right now the risk reward equation for TCS is slightly better compared to Infosys. I'm not trying to say that Infosys is a bad stock. It is a wonderful stock. If the entire Nifty IT index in India goes up, Infosys automatically will go up. But from this point, if I have to put my money on one stock, you can guess in the comment section which stock I'll be picking. Now, the third stock that I want to quickly touch upon is Mindtree. And let me first and foremost walk you through the fundamentals of the company, and then I will quickly comment on the technicals. So if you take a look at the sales have grown over the last few years. It has been generating decent amount of sales. Even this is translating into profit, which is very good news. And on top of that, they are expanding their capacity. So they have been making investments in terms of increasing their capacity. But the problem is that this capacity increase, which has come after 2020, it is not at the same rate as it is for Infosys and TCS. This is problem number one. Problem number two has to do with technicals. That if you take a look at the technicals for Mindtree, what you will notice. So again, let us plot it from 2020 onwards. And here is the peak. It has approximately given 500% return in that brief period of time. And now it has fallen by roughly 33%. So how much of the return is still intact in this entire game? So approximately, I would say 350% return is still intact over the last 2 years. This seems a little bit high for me. Now, of course, a lot of counter arguments can be made that, hey, Mindtree is a smaller company. It can grow faster. So probably the PE expansion needs to be there. Agreed. I'm not trying to debate you. But the problem right now that I see in Mindtree is that they are not trying to do anything different compared to what TCS Infosys is doing. They are trying to become the next TCS Infosys. Will they win that game? Will they not win that game? That remains to be seen. But as of now, if I have to go and make safe returns, then I will go with something like TCS. If I want to just swing the Nifty at this juncture, then probably buying something like Mindtree might also be okay. But in that scenario, I would rather take a bet on entire Nifty IT, discounting TCS and Infosys. I will not buy these in Nifty IT. If I'm swinging the Nifty, I'll buy rest of the stock and will try to swing it. Even a better way would be that I will simply go and take a little bit of global exposure in the US markets. So this is the combination that I'm looking at. I hope you enjoyed the video, and as per your risk appetite, you will do the investing. Do press the like button, and I will see you soon.